Our first speaker is Treva Klingbiel from TradeTech. Treva is well known to us. She's been speaking at these conferences right from the start. This is her eighth turn at it. TradeTech, as you will all know, is one of the leading consultants to the industry. They handle pricing. They do a lot of consulting for the uranium sector. And if you haven't subscribed to the TradeTech newsletters, then I encourage you to go to their website and do so. So, Treva, thank you again for speaking with us, and over to you. And hopefully, I haven't stolen too much of your thunder there. I'll stop sharing my screen so that you guys can. There we go. Treva, can you hear me?
I can, and let me turn on my video so you can hopefully see me. Okay. Well, it looks like you can see my slides and you can hear me. Is that right, Andrew?
Yeah, we've got you loud and clear, Treva. Thank you.
Okay. All right, great. So thank you so much for inviting us to speak again here during this conference. I think I got my video to work. There I am. Hi, Andrew.
Hello.
So it's a pleasure to be here. I can't believe it's your 8th uranium conference. That's incredible. And it's a real testament to the strength that you've been talking about and that you'll hear from me about what we see going on in the nuclear sector and with the uranium space. So Andrew's given you a bit of introduction to TradeTech. And so those of you who are not familiar with us, we do provide independent uranium market price reporting and market analysis. And we have a very strong set of team in place with expertise in statistics, mineral economics, geology, government policy, and utility fuel buying. So with that, I do need to give you our disclaimer and ask that you not make any investment decisions based upon my comments today. So there is that legalese out of the way. And let's jump right in. First, let's take a moment to look at just a few of the significant developments and announcements that have emerged in recent months and weeks. We see incredible momentum building for the expansion of nuclear power. From alliances between countries on nuclear generation cooperation to license extensions and funding partnerships, it is clear that countries and governments realize that nuclear power will be needed to meet global electricity needs. The need for secure electricity supply and energy sources has only been further highlighted by the conflict in Iran and the closure of the Strait of Hormuz. The recent upheaval in the oil markets has spilled over into every aspect of the economy, and nuclear fuel is no exception. We are seeing widespread uncertainty, and market participants are hedging their portfolios, which has contributed to greater volatility in the uranium price in just the past few days. It was down on Friday, it's up today. So let's look at this chart, which shows the historical uranium price. What is immediately apparent is that the price has evolved to show distinct super cycles, the most recent really exhibiting increased volatility. I also want to point out just how steep the rise in the most recent cycle has been. Note the low point the price reached in the last cycle, which was 2016, when the price sank to $17.75. That was a time when market prices were under great pressure from all sorts of directions, including early shutdowns, government policy that favored gas, wind, and solar, and uranium mining production costs that sat well above the market price. Since then, the price has nearly quintupled, and today TradeTech's daily uranium spot price sits at $83.90 a pound. Now, one of the things the market is still grappling with is, unlike the past, the speed at which the industry can react to policy changes, and we can see that on this graph. And in turn, how quickly both the supply and demand sides can respond to each other. The spot uranium market is now highly correlated to the overall financial markets. This dynamic can be particularly frustrating for sellers and investors who anticipate higher uranium prices, and rightfully so, especially in light of the rising demand for electricity when the uranium price and uranium equities decline due to events outside of the industry, they really become frustrated. And we believe at TradeTech that the market is going to experience these types of cycles going forward. We expect to see both large scale and mini cycles, driven primarily by trade policies and energy demand associated with the information technology sector. And in the last couple of years, we've also witnessed the upending of longstanding trade relationships, policy positions, and alliances. This has all primarily been driven by political developments in the United States, and that continues even now. This has impacted several sectors, but most important for those of us here is the impact on nuclear power and uranium mining, and that has been reflected in increased price volatility. At the same time, a lack of development on the supply side is contributing to what we see as a widening gap between supply and demand for the foreseeable future. And one of the reasons for that lack of development has been a lack of investment in new uranium production. In 2020, TradeTech began publishing a production cost indicator that showed that the weighted average cost of new uranium production was at the time below the long-term uranium price. Since then, pressure on available supply, both due to fundamental supply deficits and regional trade restrictions, have pushed prices above the cost of new production. And over the last few years, on a monthly basis, the long-term uranium price has been 34% higher on average than the weighted average cost of new production. That indicates to us that there's a fundamental shift in the production landscape where buyers are agreeing to prices that should incentivize new production. However, that production has not come online fast enough to avoid a structural supply deficit in the market. Many of you will be familiar with this graph. It shows TradeTech's baseline demand forecast, shown by the yellow line, along with potential growth illustrated by the gradient on this chart. Now, there are some important changes and adjustments I'd like to call to your attention. In the past, we illustrated the potential growth scenario with less structure, with a gradient, if you will. But you'll notice that the growth scenario is more clearly defined in this version. That is because we are seeing firm commitments across all sectors of nuclear generation. New builds, SMRs, uprates, life extensions, and restarts. And this comes at a time when the availability of production from existing supply sources is under great strain. And the new updates to our demand forecasts reinforce the fact that the evolving deficit between supply and demand indeed requires that new uranium production is required well before 2030, and that need grows significantly. The demand is there, and as that demand evolves from policy promises to real reactor construction, I want you to keep in mind the scale of the supply deficit. We have policy support. Now we need capital to develop new production in order to bridge that deficit. Now, in my last presentation here with you, Andrew, I shared with you the optimism we at TradeTech have around the development of small modular reactors. We are currently tracking over 70 companies in 20 countries working on over 80 different SMR designs. Around 20 of those companies have cooperative development agreements with utilities. And there are approximately 10 SMRs already under construction, and there are dozens of research projects underway in several countries to prove up these designs. This chart shows just a few of the more advanced SMR projects in the world today. As I mentioned in my last presentation when we talked about this, we at TradeTech see SMRs as the future standard bearer for the industry, very similar to what AI has done for the technology sector. SMRs are drawing in big financial interests and support in anticipation of exponential advancements in the future. However, the projected growth in advanced nuclear power capacity now extends well beyond SMRs. The appetite for large-scale light water reactors is growing in proportion to the rising electricity demand I mentioned earlier. And several large reactors are progressing today alongside their smaller counterparts. Today, we have 407 reactors in operation globally, with 64 new reactors under construction. Today, full-scale reactor projects constitute the majority of planned capacity, and these large units are largely behind a forecasted increase in uranium demand that could reach nearly 220 million pounds by 2030, which I have to remind everyone is just a few short years away. And speaking of the larger reactors, I mentioned earlier that we need to meet certain policy goals, whether they're rooted in clean energy mandates, energy independence, or even in energy dominance. The industry must protect existing capacity. What we've witnessed in the industry in the 2020s is a shift from economically driven premature reactor shutdowns to a long-term trend in life extensions and capacity expansions. To date, in the US, life extensions have preserved over 94 gigawatts of nuclear generating capacity. Uprates and refurbishments have added 8 gigawatts of additional generating capacity. And recommissioning is scheduled to reintroduce another 3 gigawatts of generating capacity to the US fleet. And this is a trend that is happening worldwide. Reactor recommissioning represents an unprecedented global trend. And it is perhaps, in our minds, the truest indicator of the true level of support and demand for nuclear power. In the US, where just a few years ago, reactors were being shut down prematurely, we now have plants like 3 Mile Island, Diablo Canyon, Palisades, Kewaunee, Duane Arnold, all slated to come back online. And this is why streamlined licensing orders are so critical, especially as some of these units teeter between full-on decommissioning efforts and re-entering service. And on that note, I want to also mention that several countries, not just in the US, are reversing their plans to exit nuclear power and seeking to preserve existing capacity. Just today, Taiwan affirmed its intention to reverse plans for a nuclear phase-out. Other countries, including Belgium, the Netherlands, Switzerland, Italy, are all reconsidering their exit as well. So let's return back to the supply side, because we're seeing not only the emergence of advanced nuclear technologies to support IT and other industrial scale applications, we also need to fuel the existing fleet, which itself has grown. And in terms of providing that growth and meeting that growth, we've seen an increase in exploration and mine development. Here you can see expenditures in the uranium space over the last few years. According to the Nuclear Energy Agency Red Book in 2024, expenditures across dozens of reporting countries for exploration expenditures increased and were related especially to rapidly rising uranium prices. And that capital is funding production that today is entering what is, by all accounts, a seller's market. And Andrew, you outlined that very well, talking about there is no real room for demand destruction here. For most uranium-consuming regions, recent geopolitical developments have led to significant efforts to diversify supply sources. At the same time, the number of active producers has consolidated to the point where 6 companies contribute nearly 70% of global supply and 3 of those companies contribute half of global supply. However, there is a field of emerging suppliers that is growing in concert with the recent rise in uranium prices. As prices exceed production costs and near incentive pricings, several emerging suppliers are queued in their respective pre-construction final investment decision stages. Approximately 24 emerging producers are positioned to produce up to 50 million pounds by 2030. However, fueling that immense demand is going to come at a cost, and that cost is rising. Since the fourth quarter of 2021, explorers, developers, and producers have weathered inflated costs in several areas such as chemical reagents, consumables, specialist equipment, and key services pertinent to the uranium production sector. This chart shows TradeTech's weighted mine cost inflation index between 21 and 26 and combines each year's trajectory into one index. What is apparent is the steady pressure of inflation on the cost of key consumables, materials, and services used to produce uranium concentrates. And unless significant development emerges that would drive underlying costs down, these cost increases become embedded. And that's what we've seen over the last few years. Note that we expect to see additional spikes in some of these inputs due to the current tensions that we have in the Middle East, and that inflation data does lag, and we do expect higher costs for petroleum, sulfuric acid, and other consumables due to the current supply chain disruptions occurring in the Middle East. These increases will affect everyone in the supply stack, existing and incumbent producers, as well as emerging production. So if we go back and think about how prices have been trending above the production cost indicator, keep in mind that many of the efficiencies that we've been seeing in this space are likely not to necessarily materialize. We're going to see existing and incumbent producers, as well as emerging production, get hit with some of these higher costs. So in today's market, where there's a strong focus on emerging production, the big question here is how much will new production cost and when will it enter the market? While TradeTech's production costs and price indicators help answer how much new production will cost, history is our guide in answering when we'll see that new production. In short, in today's world, it takes a long time to bring a uranium mine into production. The average time from uranium discovery to production is far greater than that of most other commodities. And here we see the time elapsed from deposit discovery to mining for 65 uranium operations. The low-hanging fruit, that is the near surface, quick and easy to develop deposits, were exploited in the 50s and 60s. Deposits have become more expensive to delineate and take longer to develop in the modern world. And those capital requirements and long lead times require a level of certainty that only long-term contracting and targeted investment can provide. And this reality is pushing uranium equities up because the horizon for new supply is relatively distant compared to previous cycles. From both a policy and financial standpoint, we're seeing greater support for uranium mines, including from retail and institutional investment. And the significant liquidity in this space is underpinned by government support. For example, in the US, where the government is providing support for domestic production with streamlined licensing, trade restrictions on foreign imports, and funding for critical mineral stockpiles. And we see these trends in other countries as well. This is all contributing to greater confidence among investors. It is exactly this kind of policy-driven financial framework that we believe will free up much needed capital for those new reactor projects we talked about earlier. That concludes my comments. I'm going to turn it back over to you, Andrew.